London-listed Cadence Minerals, formerly Rare Earth Minerals, is a business that has a growing interest in the strategic technology materials sector. With a strategy of identification of undervalued assets, it has what it calls a diversified portfolio of projects around the world, 7 in total, from early stage through to feasibility stage. It majors in lithium, a key component in rechargeable batteries, and something that many investors will know all about. Kiran Morzaria is Chief Executive, and he joins us now. Kiran, welcome.
Oh, thank you, Karen.
We've spoken to you before when you were Rare Earth Minerals. Why the name change?
Well, rare earth minerals is a suite of minerals, sort of neodymium and such, and really lithium doesn't fall into that. And we wanted to reflect the change in that we have a majority of our portfolio is lithium. And also in the annual report, we stated that we were looking at other metals in the strategic metal sector, so things like cobalt, possibly nickel, as well as just lithium. So Cadence is a reflection of a change in strategy to still identify low cost, still the same sort of critical KPIs that we see in investing in companies, but spreading that commodity base.
Now you've got a market cap, I think, around about £35 million, haven't you, at the moment? You've got 7 projects around the world. It seems quite a lot of projects for one small company to manage. What's the full strategy that you're operating?
So we tend to, on those projects, so we'll either be a majority shareholder or we'll have a JV. We're never the operator, but we take a sort of a private equity approach to it. So we'll be involved within management. So for example, on one of the projects, I'm a non-executive director on the company, and we try to assist these companies in achieving their goals, whether that be through introduction to various off-takers or potentially financing partners. We do that, so we assist them achieve those goals quickly and deliver the value. And in some cases, we don't really need to do that anymore because they've got a really good board in place and they're progressing really well. So we act as a sort of pseudo public PE type operation in terms of our approach to investment and participation.
And to what degree does the fact that you've only got a certain percentage of these projects, how does that protect you in some respects from the costs involved in producing some of these or advancing some of these projects? Because you're carried, aren't you, in some of these?
Yes, so Yangibana, for example, which is a rare earth project in Australia, so that's a free carry all the way up to bankable feasibility study. So once they start to go into bankable feasibility study or service notice that that's happening, we have to contribute on a pro rata basis, the 30%. To date, that hasn't happened, so we're getting a free carry. And that allows us to assess projects, and that's the same across even taking equity stakes or JVs. We can assess a project on every investment stage and decide that we want to either invest further, expose ourselves further, or do we see other opportunities within the market that we can utilise the same model and replicate the same sort of returns.
I want to talk about a couple of the bigger projects. Let's do Sinap first of all. This is a project, I know this is in the Czech Republic, I believe, is that right? Close to the German border. What is it about this project that makes it sort of not head and shoulders above the others, but I know it's one of the projects that is ultimately, potentially, going to be a big producer for you? Yes.
What makes it head and shoulders? I think there are several aspects to it. 2 of those are what we'd call our own sets of KPIs, so they're cost of production. It's in the lower half, so it doesn't matter what lithium price does, it's very bullish now, and even if it was down to $6,500 a tonne, it's now at sort of $9,500. It still will perform very well, generate a good EBITDA, have a great NPV. So it's protected from downside, and it's also got scale. I mean, you know, it has a in its resource statement and its PFS, it had a 21-year mine life or 20-year mine life. But that's only a very small proportion of the resource, so it can, you know, go for another 60 years if required. So it has both a unique access to a deposit that will deliver a low cost of production, and it's got scale. So those are the 2 factors on that side. But the other thing is its strategic location. When you look at where lithium market is, it's predominantly lithium batteries is produced in the Far East. We see a real change in where that's going to happen. Because if electric vehicles are going to come out of Europe, which is a big consumer of electric vehicles, some people think penetration rates of about 30%, up to 30%. Certainly, and recently, I think UBS revised their penetration rate to 30%. That means that European manufacturers are going to have to produce a lot of electric vehicles, which will create a a demand for that product. They're not, I don't think it's strategically right for them to look to effectively outsource their engine, which they don't at the moment, to the Far East. They'll want to have proprietary ownership of their batteries and their sort of propulsion methodology, much like Tesla has done. They've got the full stream. So we think it's very important in terms of strategic location in Europe. And if you look at who's developing and committing to electric vehicles, we're right bang, that Sinap project's right bang in the middle in terms of logistics.
Sinap, my understanding is it has a total net present value of about just over $500 million. I mentioned the fact that you've got a market cap of £35 million. Yeah. I think you've got about 21%, haven't you, of the Sinap project? But that equates to far more than your market cap. What's going on here? Why is the company valued at such a small proportion of just one of the projects?
So I think that's just effectively everyone's just marked to market our valuations, because it's got 21% of the equity in European metals, and therefore they're just valuing it at that value. Well, when in fact the discount that the market's applying to Sinap in terms, it's about a 75% discount to NPV overall, is far higher than is applied on other projects. So we really believe that both the Sinap and the Sonora project, both have similar discounts, by the way, have great potential in terms of increasing that price and increasing and getting closer to the NPV value. In its essence, it's going to be a function of a time as that risk reduces. But I believe, in terms of both the technical, Cadence believes that the technical risk has been mitigated completely in both of those cases, because they produce battery-grade lithium carbonate. One's got an offtake and has had two major investment houses come into it, both BlackRock and Capital. So there's providence there that people believe these things are going to occur, and they will be substantial producers when they do. You mentioned Sonora. Very briefly, give us some more flesh on the bone there, because that's another project that I know that you've got which appears above the others in terms of priority. Yeah, it's a project that we've been invested in since pre-resource, or just about resource. We had about 700,000 tonnes of lithium carbonate in it. It's now got 7 million tonnes of lithium carbonate. It's increased tenfold on that side. It's advanced from an exploration project all the way now. It's on its bankable feasibility project. It's got a offtake agreement with Hanwha, which is a major Far East trading partner, and it's got an NPV. Well, it's a year old, that NPV, so it's that was about $800 million. We expect that NPV to change, because number one, they use $6,000 a tonne for the lithium carbonate, so that price has changed, and also there's been some input increases in terms of world costs. So we expect to see hopefully an increase in NPV, but certainly it'll be as good as what we saw beforehand, we hope. Yeah. Okay. Let's talk a little bit about how you're going to reward shareholders. How far away are you from producing this battery-grade lithium that is so valuable to the market? And ultimately, when you start producing, what sort of market share are you going to be able to achieve? So the Sonora project has a timeline. Bacanora Minerals has set out a timeline, so they'll be looking to construct around 2019, assuming an 18-month construction period. So it'll be around that period that we'll see production from the Sonora lithium project. I've always said, or Cadence has always believed, that the European metals is always about 1 year behind, and so I still feel that's the same. So both of those will be coming around the time when there's going to be a massive increase in the market share. So we're talking about a market that's sort of, at the moment, they produce about 200,000 tonnes of lithium carbonate. By 2025, depending on which forecast you look at, 600 to 700, some even say up to 1 million tonnes of lithium carbonate per annum. So based on the 500 to 700, those two projects on their own would represent between around 7 to 10% of the world production. So those are significant players in production of battery-grade lithium carbonate. You just produced full year earnings. You've got £4 million on the balance sheet. What's the next year looking like? Well, we look forward to the progress on all these assets. We see Sonora doing a bankable feasibility study. We see the Sinap progressing its bankable feasibility study, which eventually will sort of duplicate what Sonora does, have a bank and have an off-taker in the longer term. So those are progressing well, and in terms of our cash burn, that's easily enough for a couple of years, assuming that we make no further investments. Although we are looking, and we'll see what we can deliver to our shareholders. Okay, all right, exciting year ahead. Okay. Kiran, thanks indeed for joining us. Kiran Morzaria is the Chief Executive of Cadence Minerals.